Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase, a podcast where we help you focus on market events that we believe truly matter. Now last night in US markets was interesting. The US 10-year bond yield nosed above 1.8%, the German government bond yield approached 0%, and the Nasdaq briefly extended losses from its most recent peak to just over 10%, or what's the common threshold for referring to it as a correction. All of these moves, though, partially reversed later in the trading day amid what ended up being a strong recovery in technology sector stocks. Now, while markets hold their breath ahead of US inflation data, today I wanted to focus a little bit on FX. Amid the drama of higher bond yields driving equity market volatility, the US dollar index has been surprisingly range-bound year to date, which makes it interesting to look for trading opportunities in currency markets. The area we favor, long-term of course, is commodity currencies, given their correlation to a positive growth outlook. So the opportunity I wanted to highlight today is the Canadian dollar. Now, many of you regularly follow FX know the Canadian dollar is also fondly referred to as the Loonie. Not as many of you might know, this comes from the picture of a loon, or a bird that's printed on the back of the $1 Canadian coin. So have a look the next time you have an opportunity to travel there and have a bit of change handy. Now we're bullish the Canadian dollar long term because Canada faces relatively strong economic growth data, robust oil prices, and a hawkish central bank. On a shorter 2 to 4 week horizon though, we also recently opened a new trade that's bullish the Canadian, or to be more specific, bearish the USD CAD pair. And that was triggered open when the pair touched 1.2780 last week. We're looking for the pair to move lower towards 1.2520. Now, dollar CAD fell earlier this week on the back of stronger than expected Canadian jobs data, as well as some US dollar profit taking. There is a risk, of course, that Omicron-related restrictions and business closures hurt Canada's job market. However, oil, which is a key export, has performed pretty well recently amid recovery expectations. WTI, for example, is up well over 10% since its most recent low on December 20th. Now, there are some technical hurdles to overcome. There are technical indicators which show the pair is oversold, and it'll most probably need to decisively break below the 100-day moving average as well. So this, together with soft risk appetite, most probably explains why dollar CADs moved a little bit higher last night. However, once these hurdles are overcome, more consolidation may then only be warranted near the 200-day moving average, which is close to our trade's target. So have a look at this trade if you haven't done so already. Looking ahead to the rest of this week, just two events worth highlighting. First, of course, is the reminder that we have the key US CPI inflation data due, where consensus is already looking for a 7% print. But we'd also keep a close eye on Fed Chair Powell and his colleague Brainard's testimonies to Congress. While these are pre-scheduled confirmation hearings, they're inevitably likely to contain some discussion on inflation and Fed policy, and markets have been relatively sensitive to these recently. As we mentioned before, any hawkish surprise from either of these could extend recent market moves, but in equities, our bias is, of course, to buy the dip. Now, if you've enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.